The market has been dropping pretty hard for the past couple weeks, I guess since a couple Thursdays ago. And it looks really, really dramatic on our charts, especially when we're, uh, you know, down in these little small intraday charts watching. I know a lot of y'all are watching the 1 minute, maybe we're even watching the 5 minute, and these drops can look really, really super dramatic, like the market's falling out, like the bottom's falling out of the market, and it's really doom and gloom and we should be panicking. We should be panic selling. Like we need to protect all our assets. And of course, I felt all of that too when I first started all of this, and it made me make some really bad decisions. We have to always be sure that we're not making investment decisions or trading decisions or anything like that out of a place of fear or desperation. So the thing that keeps me really calm and from panicking when we have these really big down runs like this is just zooming out and getting some perspective. So this is the daily chart. It's the daily chart for the S&P 500 futures, the ES futures. That's the primary market that I trade. But this will look pretty familiar if you trade any other S&P 500 product like the SPY or SPX, or even if you're a NASDAQ trader, it's following a pretty similar pattern. But no matter what the asset is, if it's been, beaten up, or even if it's been rallying a lot, or even if it hasn't been, it's always just good to zoom out to the daily and get some perspective. And I know it feels really, really boring because we don't want to trade off the daily chart if we're intraday traders, but this is really a useful chart. But what keeps this from looking really, really scary to me is just and these are all really free. It's just, I have this labeled as Barbie's toolbox. They won't let me put it out as a public indicator because these are all free things. So I'll tell you what's going on here. But when we put things in perspective with these are just ATR. This is just the ATR range. These are Keltner channels. So this is a 3 ATR Keltner on the outside and a 2 ATR Keltner on the inside. And I turned off the center line. I'm just using moving averages. So if you just look at the gray lines, those are the Keltner channels, and it'll kind of give us it's literally giving us the average true range. And for the S&P 500, we usually get into 2 or 3 ATR before we're extended and need to turn around. But sometimes, and you've heard this before, the market can stay irrational longer than you can stay solvent. And that's when we have something like this, where it's an extreme downtrend. We're still respecting that ATR range. We're still hitting the 2 and 3 and bouncing. We're just doing it over and over and over again. And that's what people are talking about when they're saying that, is the market still respecting all of this, but this still makes sense. So in perspective, we're still within this ATR extension, which is okay. This is not the bottom falling out of the market. This is a more normal correction. And putting it into this sort of perspective that we're not dropping out of the bottom of the true range, the average true range that we tend to stay in this market, keeps me from freaking out. And what we can do is when we have these dips and these just natural, the market's, it's a cycle. So we're always having these buy cycles and sell cycles and buy cycles and sell cycles. And when we've kind of hit the limits of those sell cycles is when we can look to do some buying. And I know the prop firms talk about DCA and dollar cost averaging a lot, but this is what dollar cost averaging is when there's an opportunity in a downtrend to average in and get your dollar cost average lower on that asset. So that's the kind of thing that we would be looking at with this ES chart. And of course here, this is where it starts getting into trouble. And this is why dollar cost averaging gets kind of a bad rap, even though from an investment standpoint, it can be a solid entry strategy and management strategy, is it can keep going lower and lower and lower. The thing is, it's not just the ATRs that we need to be watching. And so I'm going to draw your attention to my EMAs, or they're not all EMAs, my moving averages here for a minute. The only one that's an EMA is the 21. It's this yellow. That's a 21 EMA. I don't know why I like that one to be an EMA. I just do. So that one's just kind of what I use as a happy little median, because we're not going to travel too far from the 21. We're generally always touching it on the daily. So that gives me kind of some perspective on what a tighter range is, what a kind of tighter median is for this asset. And then I have the 50 SMA and the 200 SMA. And these are some that you'll see a lot of people talking about. So they're really good to pay attention to. But the one that's a big deal right now, we used to be talking about the 50 because that's the one that we were dealing with for a really long time. We were just respecting this blue, the cyan, this 50 moving average. Like a few times we didn't even visit it. But the thing that we haven't been visiting very much at all lately is this magenta moving average up here, this 200 moving average, 200 period moving average. This is just the simple, but on average, we visit this every couple of years. So that's where we are now. We're visiting it right now. So again, that's all still within the normal range. And when you put things into perspective, and the politics are all crazy and rough right now, but if you kind of break it down, we've got a president that wants the rates to come down. Well, what's one way to get the Fed to reduce rates? Well, to bring the market down, and one way to do that is with the tariffs that he wants to do anyway. There's a lot of things at play, and that's why when people are asking, what's the complete understanding of everything going on in the economy, and as a day trader, that's a lot to keep up with, and we don't necessarily need to know it. We just need to be able to keep things in perspective. And the perspective right now is we are very certainly in a correction or a downtrend, however you want to put it. And right now it's still all within this normal range. And the reason that people with deeper pockets get wealthy when the markets turn down is instead of panic selling down here, they're looking at what's on sale and what they could possibly buy. They do know that there's risk down here, but with that risk is where the great opportunity comes too. So instead of panicking and buying into all the hype, like hype is just such a big thing in our cultures these days. Like you've got to avoid the hype and really just kind of think of things logically, which is, if we start coming through this stuff and it makes a lot of sense that a president who wants to do a lot of economics would get that hit really hard at the beginning of his presidency so he can take credit for it by the end, because a lot of the times they don't get to take credit because of the delay in how all of these economic factors work. Because of course, grocery prices aren't down yet. There's a lot of factors that go into play, and there's, as a day trader, that's just a lot to try to keep up with and understand. We don't have full economic degrees. We don't need them. If we did have them, we would be overthinking every single little day trade scalp that we make. So instead of trying to mess with all that, I just keep it in perspective. We're in a downtrend. I'm not going to be trying to buy all these falling knives right now, because look, falling knife, falling knife, falling off, these all would have cut the crap out of me. So I'm not looking to buy those right now, but I am paying a lot of attention because we're getting a lot of opportunity on some other assets. I trade a lot of tech, and tech's really beat up right now, but we still have some opportunities. I've said that I'm eyeing kind of some Amazon and Google, even kind of Tesla or Nvidia that have been kind of more meme stocks. They're in an area that could look like a really good deal if you buy it now, even though it's scary right now. And I'm not saying to buy those. I'm not saying I have bought those yet, but those are the kind of things that you need to be thinking about when we're in a downtrend, and not like, oh shit, I'm going to lose everything, because that's the kind of thing that loses retail investors money more times than not. I've lost money doing that. You've probably lost money doing that. That's just kind of, that's where the smarts in understanding the market really come into play. It's not understanding all of the economic factors with the tariffs and the interest rates and all this other stuff. It's understanding just the kind of technical norms and what would be a technical norm and what wouldn't be. And right now, this is all pushing the technical norms, but is within the technical norms. If that starts changing, then that's like, where that's when things would start becoming a panic or a change or something like that. But right now we're just at the normal kind of areas where these pullbacks and things happen. And when you think about it, just think about it logically. Like, this was ridiculous. Like, this was inflated. There's no way that this was really, that the market really had this much confidence in the post-COVID world, like this was hype. This is more hype in here too. So when we start drawing some straight lines across all this stuff, it kind of makes a lot more sense and makes this hype feel a little bit more like hype. And that's what we use the moving averages for. So I hope that's a little bit of a little Barbie thought long, but I hope that kind of helps you understand how I keep calm when there's all of this panic in the markets and how I start to look for opportunities here. Although here's the one caveat that I'll add. If you want to avoid falling knives, and I should probably do a separate video all for this, you have to wait until something is reclaimed. So right now we're in a downtrend. We want some clue that the downtrend is over, which we don't have until we stop downtrending in some way. So for me, that's usually reclaiming a major key level. Right now, we've got a pretty obvious one. It's the 200 moving average. So if we can get over that and hold that, then that's a lot more confidence that this is a good place to dip buy. You can't just buy every single dip. You still need to put some thought into it and have some reasonable expectations. We're not trying to be I bought the low. I got the very, very low tick, and so I'm the winner. No, the winner is the one that can make income regularly, and whether they call the low or not. And the higher probability is going to be when we're at least with a shifting trend, even if the trend hasn't developed yet. If we're kind of at the very beginning of it, it's going to be up here, not so much down here. So I hope that puts things into perspective. And of course, join me at all my things, like the video so that other people can find it. And so I know you liked it. And of course, you can visit me on my website and in the Discord. So I'll put links for those everywhere. And I'll see you next time. Love you. Bye.